This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
Welcome to another episode of StockCast. And this is actually one that I'm especially interested in because it's for people like me. And this is actually a question that came from our comments. And it's, like I said, it's one I really need the answer to. And the question is, Andy Tanner, how does someone with a modest amount of money get started investing in stocks? And I got to tell you, this is an important question. A lot of people have this question. This is the first time it came up in the comments. And I'm just going to say it's an important question because starting out is one of the most important things. And if you go into it feeling like you're already losing, you can't do it, then you're going to have the mindset that's going to make you fail. So Andy, we'd really like you to give us a little hope here. So Andy, how do we start with a modest amount of money?
First of all, this is a fabulous question. And to tell you the truth, Greg, I've been a student of learning how to do this for about 30 years now. So I'm still learning. But as also when having learned a lot and also been a teacher, you can imagine I get this question, I don't know on a daily basis, but at least a couple times a week, because, obviously people that, are starting out with modest means, they want to improve their situation. So they're looking for a teacher. So I get the opportunity to rub shoulders with all different kinds of people, different cash flows, different net worths. And I actually do have some good news for people.
That's good. One other thing that comes to me with this question is, and I don't want to take this out of context or say this the wrong way, but a lot of people, when you have a small amount of means, you're kind of desperate. You have this, I got bills piling up, I got a family to take care of, and you're feeling the stress. And so I think there's almost two layers. One, maybe you don't have a lot of money, but two, you're going to be a little bit emotionally taxed out, if that makes sense.
Yeah. And that's I think that's actually a great place to start. You mentioned being emotionally taxed out. The good news I have for people is if you can be cerebral and you can think a little bit and calm your heart a little bit, you can start a pathway to some pretty prosperous places. And I'll speak to that. I think we have a lot of things to cover, but let's first talk about that emotions. You can be very vulnerable. And so let's talk about first before what can happen, what you can do, maybe about what won't happen, what you might avoid thinking to do.
All right.
And we'll get both sides of the coin, so to speak, that way. When we all have a brain and a heart, emotions and thoughts. And I think, if you went back to the cavemen or even back before, when we were all amoebas or however that all happened, we felt before we thought. In other words, an amoeba doesn't do things because of how it thinks. It has reactions based on the stimulus from its environment. It doesn't really think it through, it just reacts. And we still have a little bit of that in us, I think. If you've ever made a mistake, maybe you said something that you wish you hadn't have, you might have been overjoyed and maybe got a little bit overexcited in what you said.
Sure.
You might have been sad and so depressed that you said things that, just kind of were out there. Or maybe you were angry with your spouse and you said something to the person you love that you really wish you could reel back in, right? Crimes, you've never had crimes of intellectual logic. It's always a crime of passion where we mess up. And so really, if you're starting off with modern means, be careful of greed. I know, Greg, that when I get on YouTube and Facebook and Twitter and Google everything, they're tracking what I look at, just like they are with anyone else. And so they know I'm interested in investing. So I get advertisements that really prey on people that are in that emotional state. I see them all the time. I'll give you some examples. I saw an ad once that said, we made $40,000 in 3 weeks without doing any work.
Right.
Let's look at that statement. Let's just look at that statement. On the one hand, emotionally, that's freaking awesome. Okay, 40 grand, that's like the Garden of Eden. All food, all wonderful stuff, no bad stuff, no work, no toil, free. That basically says free money, right? 40 grand in 3 weeks without doing any work. Now, let's look at the logical side. let's test that theory, you and I. You and I take 3 weeks off. Let's just go to Bermuda and sit on the beach for 3 weeks and see if $40,000 comes without doing any work. So, another advertisement that sticks in my mind, someone said, our system picked only winners 87 weeks in a row. That's almost 2 years straight without a loss. I've been trying to do this for a long time. I've never gone that long without a loss. Okay. Mark Buffett's never gone that long without a loss. And so, another says we make all our money out taking risks. Well, these messages that are unfortunate messages, well, why do people put them out there if they're not likely to be true? Well, or not likely to be typical, maybe. Well, it's because of how they make people react and feel, right? And they get them all in a frenzy and they get their hopes up and say, oh, I take my little tiny nest egg and I put it out there and boom, I got 40 grand. And that, I think, that greed can lead to a word called credulity, which is a polite word for being stupid, if I can say that. And so the first thing is don't expect to solve this problem with a child's mentality of, like in Willy Wonka, the spoiled little, whatever her name was, I want a Loompa Loompa right now, Daddy. I want everything right now. When my boys come to me, they have modest means because they're 13 and 15, so they're not rich yet. And they're in that same boat, right? They are saying, hey, I have modest means. When I start. And here's the first good news I have for you. The thing I've told them is whether you become a business owner, whether you become a real estate investor, a stock investor, if you deal in commodities, one of the principles that I think is a bedrock solid principle to talk about is a word called compounding. Now, if you just simply Google compound interest and compound interest calculators and compound whatever and begin to study compounding, Einstein, I think I don't know if he really said it, but he's often credited with saying that compounding is the most powerful force in the universe. So if that's true, or even if it's slightly true, or even if it's in the top 5 powerful forces in the universe, you can tap that regardless of what amount of money you're starting with, because there's 3 ingredients. There's money, rate, and time. And so the bigger issue maybe isn't how much money you have, is how old you are and how late you're starting. So we'll talk about that as well. But I will tell you that if you look at a compounding graph early, you're not going to see much. And you might, if you take a 2 or 3 year horizon, it's not going to be that exciting via the work you put in.
Right.
But man, I'll tell you, once you get into that little hockey stick move, and it goes less horizontally and starts going more vertically, compounding gets very, very, very exciting. And that is a place where it's okay to be excited. The problem is...
Can I stop you real quick? So compounding interest requires delayed gratification, which you mentioned earlier.
Thank you.
I actually read, they surveyed some of the most wealthy people in the world. And, they're very diverse. They have all different strategies and thoughts. But the most common thought they all shared was you have to have delayed gratification. So I think what you're saying is not just in line with your belief, it's in line with the belief of the wealthiest people in the world.
It's science. There was a study, interesting you bring this up. There's a study, I can't remember the name of the professor, but it was at Stanford, I believe. And they took a bunch of 4-year-olds, like a ton of them. And they took them one by one, they put them in a room and they put a plate and they put a big marshmallow on it. And they said, you can have this now, but if you can leave it there until I come back in 10 minutes, you can have 2. And that was it. And, these kids are like, dying. And some kids just said, forget it, I'm eating the marshmallow. Other kids found ways to preoccupy. They looked around the room and found something else to do to take their attention off it. All this stuff is going on. And they tracked these people throughout their lives till they were like, 30 or 40, years old, 50 years old in adulthood. Amazingly is that at 4 years old, those that had that disposition with an ability with delayed gratification had higher net worths, better financial situations, better lives, better health across the board than those that hadn't. So that idea of compounding and getting away from the messages of get rich quick and, we're going to take you from rags to riches, those are designed to appeal to your emotions, not your sense of intelligence. So,
right. So when I was in marketing,
compounding.
When I was in marketing, there was only 2 things you stressed: greed, and fear. If the
Yeah.
economy is doing good, you stress greed. And if the economy is doing bad, you stress fear.
Yeah.
And both work.
Yeah. And people are driven by emotion, which is fine because that's what makes me a human being. I wouldn't want to be Spock. I love having love for my kids. I love feeling excited in a basketball game. I like coming back from a loss. I like those emotions. So I don't want to get rid of them, but I want to bridle my passions if I can. Okay, so that's number one is trust compounding. Begin to study compounding, and that'll get your hopes up, even if you're starting with a Lincoln penny, right? Okay, you can start compounding with a Lincoln penny. Okay, the second thing I'm going to talk about speaks more to the stock market than our asset classes. You can compound in business, as I have. You can compound in real estate, stocks, whatever. But yeah, the idea of stocks, it brings a couple things to the table that I think help the person that's starting out with modest means. Example: the stock market often has traits that are not better than other asset classes, but are just different. And here's one. It's called scalable. So what that means is there are deals that come across my desk that are for accredited investors. Now, what an accredited investor is the opposite of the person asking this question. They have at least $1 million liquid, not including their home. They got $1 million net worth, or they make over $300,000 a year as a couple. I think it's $250,000. I don't know what it is for a single, but anyway, as an accredited investor, I will get deals across my desk that the person of maybe more modest means never gets the chance to see. And it is kind of silly because what if I inherited my money? Having money doesn't denote intelligence, but they say, well, if Andy can be an accredited investor, he's got enough money that if he loses it, it's not going to hurt him. That's the way they see it. So, one of the things that's tough is, let's say Kenny McElroy has a deal for accredited investors. And that's not going to be you can't join the rich and invest in what the rich do. Sometimes Robert Kiyosaki says in his cash flow quadrant of ESBI that B stands for investor, but also stands for insider, the guy with the inside track. Boy, there's a lot of truth to that. Guys in those circles tend to get great deals with better returns than the average, mutual fund guy. So, and that's just a fact. So one of the things that's nice about stocks, though, is it's scalable. So let's take the greatest investor of all time, in my opinion, who is Warren Buffett. And he's bigger than anyone that we know. And Warren Buffett owns a company called Coca-Cola. And so do I. So I am partners with Warren Buffett. Now, I don't own near as many shares. He owns more shares than anybody. But my son could go out and mow someone's grass, maybe get 3 or 4 lawns going, and before long, he could choose to invest that money in an immediate gratification, like maybe an Xbox game, or he could say, I'm going to go into compounding. I'm going to invest a small amount of money into a company like Coca-Cola, and let's see what happens with rate and time. And with some financial intelligence, we can accelerate that rate. We'll talk about that in a moment. So one of the things that's nice about stocks is a person with modest means can often get involved. You might not be buying Amazon and Tesla, but imagine owning companies like AT&T, like my son does, or Kraft Heinz, like my son does, or some of these household brands. I mean, you'd imagine the person that owns companies and brands like that are probably very rich people because they're great businesses.
Right.
And so that scalability is good news to begin participating in compounding with modest means. So that's the second. There's about 3 more things we got to cover. So the first one is embrace compounding. The second is that realize that stocks are not only agile, but they're also scalable.
So can I interrupt you? Because my lazy brain's talking now. And it's saying, I don't need the financial education. I'm just going to look what Andy and Warren Buffett do, and I'm just going to copy them.
Oh,
sure,
boy.
I'll scale low, but eventually I'll bring it up in my compounding.
Boy, there's that culture of advice we always try to disrupt, right? Where people say, just tell me what to do. And they ask for a fish instead of learning how to fish. And they can certainly try that. But I think in their heart of hearts, if they move from that heart of hearts into the head of heads here and think with their head, they're like, why has Warren Buffett done well? Is it because he would decide to buy stocks or because he got really, really smart? Same with Kenny, same with Robert, same with, the Rich Dad Advisors. I'm not a perfect investor. I always feel like I'm the least of the Rich Dad Advisors. They're so smart. But I will say that the successes that I've had have come, I think, because of what I've known, and the failures that I had, I think, because of area I might have been ignorant in. So that's a good point, is the education part. And I'll tell you, in fact, we're at the end, we'll revisit that education part with the last important comment I'll have to say. So let's look at the third thing I'll have to say on this. Number one is compounding. Learn about compounding and trust it. Number two is the stocks are scalable, so you can participate with billionaires and the things that billionaires own without being an accredited investor, right? It's tougher to do that in real estate business. The third thing is this. Let's talk about the amount of money. People often say, how much money do I need to get started? Or they'll say, what's the ideal amount to get started in stocks with? And I go, well, the ideal amount would be $2 billion. That would be great. 2 to 4 billion would be an ideal amount. I would love to have started with that. And I say, let's maybe change that question a bit. The reality is you're going to start where you are. And so really the best amount of money to start with is what you got in your wallet right now, because that's what you got right now. That's what you're doing. And so don't wait and think, well, I have to be, it takes money to make money and all this. You have to be rich. That's like my son saying, I'll begin taking piano lessons once I've, got a few recitals under my belt. It's putting the cart before the horse, maybe a little bit there. So understand that the compounding is a huge, huge deal. Understand that scalability is a huge, huge deal, and understand that starting now with whatever you have is the ideal amount for you. Let me say it again. The ideal amount for you is whatever you have right now, because compounding has money, rate, and time. And that time is the bugger. That time is the thing that sucks, because, if you're 75, you got less than my sons who are 15. Right. And so the immediacy and the urgency of picking up that first investing book and getting into that first investing course and investing first, there's this little video they used to have called Prime the Pump, where a man's car breaks down. He's walking, he decides to walk out in the desert. He comes upon a ghost town with no one there, and there's a pump, and it doesn't work. There's no water, but there's a bucket, and he sees a little bottle, and you pull the bottle out of the bucket. There's water there, and a note that says, "Don't drink this water. Prime the pump. Take this little bit of water, prime the pump, and this pump will give you more water than you ever needed. Then fill the jug up, put the cork in the note, and leave it for the next guy." And so the guy's in this dilemma. Do I take this small amount of water and put it into something that can teach me to get more water, or do I just drink it? And that's very much where a person is with their modest means. I think maybe the best investment would, I think it was Abraham Lincoln or someone said, if I was going to chop down a tree and I had 2 hours to do it, I'd spend the first hour sharpening the axe. Right. And so investing in yourself first is an important thing. But more important even there is the immediacy of going right away with compounding. When is procrastination ever associated with success? Ever? When has everyone, gone, one entrepreneur invested a year and said, I got here because I procrastinated. No, we won the state championship because we procrastinated. It's just human nature. So number one, compounding. Number two, scalability. Number three, start where you are. That's the ideal place to start for you. Okay, number four, leverage. In order to, so you have a fixed amount of money you're starting with, whatever it is, and you got a certain amount of time. To achieve your goals, the greatest variable is going to be rate. Higher rates require more risk. Higher risk requires more smarts, more education, more aggressiveness. And so you cannot, you can do whatever you want, but I wouldn't recommend going very, very risky unless you have education. So let me talk about leverage. How do you accelerate those types of things? I don't know if we can put a link to this. Maybe we can give someone I have a course called How the Rich Invest with No Money. And it talks about how the principles of wealth work, where in reality, Kenny as an accredited investor invests as if he had nothing. In other words, his model is set up as if he has no money. That's good news. Warren Buffett is set up that way. That many investors are set up that way. In real estate, we can use OPM. We can use other people's money to acquire assets and increase our rate of compounding. In stocks, we can use the options market. This takes tremendous knowledge, but you can do this without debt and do it by contract. I'll give you an example from my own life. Warren Buffett, back in the subprime meltdown, helped a bank, and he went to this bank and he sold some warrants to them, that said, hey, I want the right, or he bought some warrants. He says, I want the right to be able to convert my stock at a certain share price. When he got interested, I thought, I don't know if I want to spend a lot of money in the stock, but I bought something called some leaps, and they're options. They're long-term equity anticipation securities. One of the best wins I ever had is using a levered instrument. Now, these are very, very sophisticated, and I wouldn't say they're a lottery ticket because there's time decay, there's risk involved, but there is leverage, there's risk involved in debt. So if you become a master of debt or a master of leverage and the risk and are able to manage the associated risk, your rate can go higher. Now, one last comment on this, and we'll move to the last idea, okay? People in a context of a job, Greg, are going to want to know what they're going to get before they start a project.
Right.
They do not have the emotional strength to travel into something with ambiguity. I'll give you an example. I tell my son this all the time. He has some goals to play basketball at a high level, and I cannot give him a guarantee that it will. I don't know what his body's going to do yet. I don't know I don't know if he's going to be as tall as I am, or taller or shorter. I don't know what's going to happen, but we are pursuing that as if it's guaranteed to happen, and we might wind up disappointed. But we're going to put in the work and the time to develop his game as if that's where he's heading, and we might be disappointed. A lot of people don't have the mental ability to do that, especially job people. When you go to a job interview, picture yourself across the desk from your potential boss, and you begin to talk about compensation. And you say, well, how much does this job pay? And the boss says, oh, I don't know. Somewhere between losing all the money in your bank account and making $1 million, somewhere in between there. Yeah, but could you tell me what it's going to be? No, I really can't. Don't know what it's going to be for you. But just show up to work. Tell you, come to work for 5 years, then we'll see what we pay you. How about that? See, that ambiguity would never work with an E, but yet that's exactly the answer in the I quadrant. Is I don't know if that compounding is going to be perfect or whether it's not, but I'll tell you, I can give you this guarantee: if you don't compound, you won't get any. Right. And so that's a very, very important thing in leverage, is understanding that leverage comes with knowledge, comes with risk, and comes with ambiguity. You'll notice a pattern here in our first few principles. Number 1 was compounding. Number 2 was scalability. Number 3 was getting started right now. And number 4 was leverage, right? Some sort of leverage. Every single one of those requires an emotional personal development. We started off with, well, I want the money now. Calm that, be stronger, compounding, right? Well, I want it big now. Scale it down and use the scalability by 1 share, right? Procrastination. No, I'm going to overcome my idea of putting it off and take action. It's all personal development, Greg. It all is. It's all about how strong you are as a person, developing yourself. So with that, I'm ready for a final thought.
Well, let me just throw in real quick, especially when you're talking about debt and leverage. One of the things Robert says is it's like a loaded gun. If you have the education, you can use it to hunt and provide food. If you don't have the education, guess what? You're probably going to shoot yourself in the foot or who knows where. So it can be the greatest thing, but if you don't have the education, it can be the most dangerous thing you do.
It's really true. A hammer is the same. You can use it for demolition, and you can use it for construction. It's just a tool that gives you more power than you have with your bare hands, right? It's just it's just that important. So these are some of the concepts that are very, very, very important for people to understand. Here's the final one that I'll give you. One of the advantages of stocks is you can participate and learn with zero money. And I think this is the only asset class or the easiest asset class to do this in. There's things I've learned in business that just come from experience, getting sued, getting, all these things come from experience, failures, whatever. Real estate is a, the closest you get to practicing that is probably playing the cash flow game, which will be a pretty basic simulation. But with stocks, you can actually set up a simulated account, which you should do even if you have $1 million to start with. And you're going to start learning the same way that a person with $1 million learns, by starting with 100,000 fake dollars, let's say, and let's see what you could do if you had $100,000. And those charts are going to be identical. Those option strategies, identical. That fundamental and technical analysis will be identical. The risk management, identical. The different positions, identical to what you'd be doing with real cash. And you're learning. And I'll tell you what's interesting is when money comes into your life, maybe you want to spend $10,000 and refinish a deck or improve your home in some way. And you say, oh, great, I'm going to save up and spend that money on a liability or a car or, whatever it is, sporting equipment or vacation. But all of a sudden, what if you have this virtual money and you discover over time, not overnight, but over time, that you actually have the ability to put money to work for you? Now the temptation to buy assets rather than liability is tremendous, and you'll be surprised. You think you're short on money? What if I gave you a machine? What if I gave you a machine that if you put $1 in, you got $1.10 out? Just 10%. You put $1 and $1 in, and I gave you that machine. Okay, all of a sudden, when you get paid some dollars, where are you going to put that money? You're going to go buy fishing boots? You're going to go get your nails done? You're going to get hair extensions in? Or are you going to put the money in that machine because you know that machine can turn that dollar into $1.10? So the psychology of paper trading and simulated account changes the way you think, and it changes the way you'll spend your money, because all of a sudden you'll find money you are spending that you didn't know you had. You'll be going through your budget and saying, why are we spending on this when we could have turned the dollar into $1.10 maybe over the next year or whatever? So those are the things I would say. And I think it's good news. The financial education is where it starts, and the personal development is where it starts. We talked about dealing with emotions of greed and feelings of procrastination. You'll be able to delay gratification and do things now, where procrastination is not doing things now and delaying hard work. And so I would just kind of close the way I opened is, these messages of $40,000 in 3 weeks, I think they harm people. I think they harm their context. I know they're attractive. I think these messages of, 87 weeks in a row without a loss, they are targeting a person's weak emotions of greed and psychology to their own benefit, where my counsel is study compounding, get an education, take heart, look at that old compounding graph, just go up late in the end and say, look, I'm going to do this now, and I'm going to see great rewards in the future, and then learn to leverage. If you're older and you have no money, leverage is your daddy, and leverage means education, because if you lever without knowing what you're doing, you can go from the frying pan in the fire. So I hope those are helpful ideas if you have a modest account. Hey, brokerages will let you start trading with $2,000, $500, and start that compounding process with very little money. So that's my message to those that are modest means, either young or old. And those are some things to think about. And can I give myself a plug?
Please do.
I hate plugging myself. It seems like it's bad form. I get emotional when I think about this. I used to, sell software. I used to travel around and I did a lot of speaking, and people would advertise, come and see the stock software. And I would see and I bet I've seen, Bon Jovi says I've seen a million faces. I think I might have, I don't know if I rocked him like he did, but without a doubt, every event, someone would come up to me destitute. I've just had health problems. I've just filed bankruptcy. I've just got divorced. I've just lost a child, or, just destitute of money because of some circumstance in their life. And I never had the time to give the presentation I wanted to give. Never did, Greg, because I'm selling software for somebody, right? I got to give the sales pitch. And I wanted to heal these people by changing the way they thought about it, because their mindset was wrong. And so years ago, I thought, if I could get all those millions of people I've spoken to in a room that were destitute, and I could teach them a class to change their mindset about how to go from rags to riches, how to start with nothing. I call this class How the Rich Invest with No Money. And it's very emotional for me because I take it from my own life. My folks weren't rich. They're wonderful people, but they weren't rich. And I knew if I was going to make $1, I was going to have to go make it. And I talk about my failures. I share my failures, but I talk about how I've used these principles in business, how I started my business with zero. You start your stocks with zero, real estate, zero. And I share that experience with my little course called How to Invest with No Money. I'm embarrassed because I don't know. I just gave it to my team and said, you guys offer it, but I don't even know where to go get it. But
I actually do. I actually have taken that course. So
have you really?
Yeah. So you can talk about it and call it a plug. I can talk about it and say I took that, and it really did change my mindset, and not to use the wrong word, but it gave me hope and it made me realize the possibilities.
Fantastic. So there's my message to those who are starting off with modest means. You can do it. Get that compounding, get that education, get that personal development. Other people have done it. You can do it too.
Yeah. And my favorite part is you gave solutions for the young, but you also gave solutions for guys like me. So I really appreciate it. And I will find the link to throw it in the show notes, and let's just help a lot of people.
Greg, I'm so grateful for the opportunity to be with you every week. It's a highlight, and I hope people benefit. If you have things you'd like us to address, please put it in the comments. We read them, and Greg collects those, and we'll put it in the tank for future programs.
Sounds great. Thank you, Andy.
Take care.
Have a good week.
You bet.